Welcome to our Market of the Moment update for the week of August 22nd, 2022. Michael Oldham with the Oldham team and EXP. Chris Madrid, Guaranteed Rate. What's up?
Hey, what's up, man?
Hey, long time no see. Been a couple weeks. Couldn't get you on last week. Had to knock out.
The week of August 15th, interest rates dropped a little bit, probably down in the mid 5 range. So, 5.5 to 5.7, which we hadn't seen in a little bit. And then for the week of the 22nd, right, which is this week, we lost basically all of that, and rates are right back up in the 5.7 to 5.9, 6% range. So we're now, for par pricing, meaning no points, nothing like that, you're at, probably at 6, if not a little bit over. And then, man, and that's that's assuming excellent credit, right? So that's assuming 740 credit score and above. So for anyone in the lower, below 700, gosh, that's 6.25 to maybe even 6.5, right? So there's a pretty big swing on conventional rates based on credit score. So that's, those are some of the things that we talk about, right? Is make, when you're in the process of purchasing a home or even looking at buying, we cannot stress the importance of making sure your bills are paid on time. Any medical expenses that you would have had, that is kept up to date. There's some new legislation that's going to be coming out related to medical collections and the impact that they can or can't have on your on your credit score, but it's not completely rolled out yet, right? So so now, right, there's still going to be you're still going to have that impact on your credit if something goes, if your insurance company doesn't pay it on time, and then the hospital or emergency clinic, whatever it is, they send it to collections, that's still going to ding your points. And I have a customer right now, 100 points, right? So he went from a 750 down to a 670. So 80, 90 points, right? But almost 100 points. And that's a significant difference in rate. So again, those are things we can't stress enough, to make sure you're staying on top of that. Well, to start the day, stocks are mixed, and mortgage bonds are lower than expected, which that was as of today, but that was also the kind of the story of the week. The Fed's favorite measure of inflation is the PCE, personal consumption expenditures, show that inflation fell like 0.1%, right, in July, which essentially was in line, with expectations. So not a whole lot of movement there. Year over year reading fell from 6.8 down to 6.3, which was higher than what they had expected at 6.2, right? So the core rate, which strips out food and energy prices, rose by 0.1, lowering the year over year change from 4.8 down to 4.6. So things are headed in the right direction, but we're still seeing inflation over 9%. And as long as inflation's an issue, mortgage bonds specifically are going to be struggling, right? And the next month, right, the Fed's set to meet again. They've already indicated they're going to increase the federal funds, right? We've been talking about this all year.
Yeah.
So there was a meeting today where, one of the Fed presidents, Bostic, also he appeared on, CNBC this morning, saying that he hopes to get restrictive policy by year end, which he defined as federal funds rate in the 3.5 to 3.7 range. And the more that the Fed backs it down on what they've been saying as far as increasing the federal funds rate, combating inflation, man, it's not good for bonds, right? And it's not good for mortgage bonds specifically. So we'll see the kind of the increases that we've been seeing this week. So looking at the charts here, we're pushing. We've fallen, like right now we're at 99.91, which means that we've fallen below that, that 100 level, which it kind of, if you're looking at that between August 22nd and August 29th, that 100 over there, the 100 basis point mark, I mean, that's a big indicator on kind of where rates could be going. Because if we drop below 100, then that next floor support is 99.281. And man, if we start to get down, you know, to those levels, I mean, that's when we, you know, we really started to see, if we look back in June, right, when rates they went over 6%, right? They were 6.25, 6.5, assuming excellent credit, right? So not even the 5.7 to 5.9 range, you're over 6. So these are, you know, those are just some things that that we're watching, and ultimately, you know, if we see these little upside down triangles, you can see there, like on August 22nd, there was a couple of notifications that were given to lock in interest rates. So if we're, you know, if you're at that point and you're looking at, you know, at purchasing in the next 30 to 60 days, we may take one of those opportunities to go ahead and lock in an interest rate, regardless if you have a contract, because again, just the volatility that would be coming over that next month or two could, you know, we could start to see within that period of time rates going up. So that's, again, we talk about this all the time, right? It's important to obviously work with somebody that knows, that understands the markets and can advise, like, hey, today's a really good day to lock. So those are the things that we advise on our end.